Welcome to the iAIM Investment Management's first quarterly macro update for 2023. My name is Rose Marcello and I'm Director, Client Portfolio Manager with iAIM. Today, I'm speaking with Sebastian McMahon, who is our Chief Strategist, Senior Economist, and Portfolio Manager. Sebastian is responsible for a variety of managed multi-asset portfolios at iAIM. Good morning, Sebastian. How are you doing today?
I'm good. How about you?
I'm doing well, thanks. Happy to have you here. So we've had like a rough little start of 2023, more than we expected.
Mhm.
And there was a lot of pressure and stress in the banking sector. But now we're kind of a crossroads where the central banks have used a lot of tools to kind of tame things down. And what we've heard in the past few weeks has been that both the US Federal Reserve and the European Central Bank are now convinced that they can keep their different tools separate. And what I mean by that is that tools for financial stability, such as the liquidity measures they introduced in the past few weeks in response to the banking stress, and separate from the tools to fight off inflation, namely rate hikes. In your opinion, how confident should we be in their ability to do so?
Well, I think we should have some confidence because in theory it's right that they do have different tools and the interest rate is a blunt tool which has lots of importance for the economy, for monetary policy, how successful they are in implementing that, and the relative pricing of assets within financial markets. And that if something goes wrong elsewhere, they can always, activate a new facility, a new program, and just address that, just like they did following the SVB fallout. But now it could be a situation that's not as easy to take care with different tools because what's responsible for, in large part, for the bank turmoil, and we wrote about that in our April monthly piece, is that quantitative tightening, which is just an unwinding of all the money that was injected in the economy in 2020 and 2021, is the thing that's putting pressure on deposits and it's hurting banks. And it did contribute to the SVB fallout. And until they stop that, or if they don't stop it, we could still have some pressure on the banking system. And we have, higher leading rates, which makes money market funds more attractive, draining some more deposits out of banks toward money market funds, which send that at the Fed to the reverse repo facility. So you have one thing that's creating one part of the monetary policy that is creating pressure. You can always solve that with something else, but at some point, where does that give? And that reminds us a lot of the savings and loan crisis in the 1980s in the US, where the savings and loans institutions had some issues because of the fast tightening of monetary policy. And at some point, the Fed was still fighting with inflation that was post-Volcker, early Greenspan years. They couldn't just, stop hiking because they would lose their fight against inflation. So they had to do lots of things and they had to involve more institutions, more regulators to solve the thing. But since it wasn't a blunt solution, that did cause a lot of volatility, lots of stress. So maybe we could be headed for something like that if the current environment persists.
Yeah, I understand. And just to be clear, during that savings and loan crisis in the US, the Fed continued hiking rates. It's just that they took specific measures to stave off, like to prevent failures or to make it more orderly, right?
Yeah, exactly. And the markets tend to love blunt solutions, just like let's say March 2020, COVID hit and the Fed just announced, interest rates at the floor and lots of QE. Then the markets tend to, all right, the calm returns and everyone's happy. But when it's more specific solutions, it also comes with a lot of risk, difficulty in reading things correctly, and this brings volatility. So maybe we're headed more into this kind of picture than something that would look like a 2020.
Okay, so another volatility, or maybe. So
Mhm.
if we look at the stress that we've had in the past few weeks in the financial system, what are the main weaknesses that your team and you have identified, both at the macro level or even within specific asset classes?
Yeah, sure. The when there's turmoil in banks, you need to pay attention and you need to have some worries as part of your economic scenario. So being optimistic or bullish too quickly for us, we think it's a mistake. So as long as we have some risks on banks, we remain careful. Inflation is also more persistent than anyone would have expected at this point of the year, and the economic momentum also is pretty strong. So we think it's too early to expect the pivot from central banks or even just, central banks to stop hiking everywhere. The Bank of Canada is in a pause. Economic momentum is much stronger than it expected. Inflation is more resilient. Will it come out of its pause to, let's say, have a safety hike or two? These are things that we're looking at. There's still alternative scenarios, but we think they need to be priced in. So maybe if there's a risk, is that the stocks, the stock market had a good start to the year. Technology had a great start to the year. Nasdaq is back in the bull market because of the expectations that we're at the end of the hiking cycle. If there's one place where there's risk right now, it would be that part of the complex.
Okay, understood. So, looking at this, have you revised either your short-term or mid-term asset allocation?
Not so much. We did tweak it in January. We became a little bit less careful versus equities as a whole, and in the fall, and we changed our stance through the fall and in January. We used to have an underweight in Canada, U.S. emerging markets, Europe, pretty much spread everywhere. Now we decided that based on the split in valuations, we concentrated are underweight in the US and we're neutral in every other region. So Canada, EFI, and emerging markets were neutral. It's all underweight in the US. We have an overweight on fixed income. We're long duration. We have some cash on hand to be opportunistic, and we've stayed there through Q1 with all of the turmoil because we're positioned for some volatility. We did look at gold. Gold, if we're at the end of a hiking cycle, gold makes a lot of sense. We did play with it a little bit left and right. Now we don't have any gold exposure, but if when we do feel that we're at the end of the hiking cycle, gold is likely to play an important role in our portfolios, but not yet.
Great to hear. Well, thank you so much. It's always so many details that are very informative for our audience. It's a pleasure, Sebastien.
Yeah, thank you, Rose.
Have a good afternoon.
How you do?